Hello, everybody. So today I want to talk about two lifestyle stock, two quote unquote Neobrands that I find pretty cheap, that I've not run yet. And these are stocks that I'm interested in buying. So the first stock is Figs, and the second one is Lovesac. Let's be honest, the main reason why these stocks are on my spreadsheet is because the valuation is just insanely cheap, and I cannot understand how cheap these companies are. This is especially true for Lovesac, but for Figs, it's pretty cheap. Like it's first quartile cheap. Anything under 0.2 on my spreadsheet where I use enterprise value over gross profit or revenue growth, that's pretty cheap. If you look even at gross profit, trading 2.5 times gross profit, inexpensive companies. And as you see, okay, Lovesac had a little bit of a run this year at plus 30%, but nothing compared to a lot of the stocks I cover on the channel that are up 100% in 12 months, right? And Figs is actually still down 8%, even though it had a little bit of a run in September. And what's even more crazy to me when I look at this valuation, especially when you look at a price to sales basis, how cheap these stocks are. What I find even more interesting is they're gap profitable. The market is supposed to like gap profitability, right? That's all you hear about. You hear about buying companies before they become gap profitable. I stand on my own saying that I don't care about gap profitability. All I care about is gross profits, and then I'm going to trust management to invest the money after the gross profit line. I'm going to trust them to invest it how they want. I'm in no hurry for my companies to pay a bunch of taxes. But anyways, these are companies that did everything that the market wants. They rushed to gap profitability, and they got no reward. Right? They should have invested in their growth, because if you look at the growth, keep in mind these companies a year and a half to 2 years ago were both growing at 30% revenue growth each year, both of them, whether it is Lovesac or Figs. It's gone down. Why? Because they're halting the marketing spend. They're spending less on marketing to please Wall Street. And then look at how you get rewarded. You get rewarded by having a price to sales ratio of a 0.7, because Wall Street's very smart. Wall Street's saying, furniture is never going to be sold again. So let's sell off the stocks because nobody's ever going to buy furniture again. Anyways, it makes very little sense. Very little sense. So I'm just going to walk you through quickly for each stock. These are stocks that I've covered in depth on this channel before, did full analyses on both of these companies. But anyways, let's talk about Figs. So what is Figs? What is Figs trying to do? Well, Figs is trying to pull off a Lululemon, in my view. In my view, that's one of the key reasons why I would want to own Figs. I used to own it really briefly, but I sold it out for better opportunity. One of the reasons when I get into Figs is really they are trying to disrupt the old world of scrubs, and the healthcare system is actually a huge sector. The healthcare world is actually a huge sector. What they've done is they've taken baggy apparel, right? Not very great, very standardized, and they've made it into a fashionable item for doctors and nurses, and of course beyond doctors and nurses. We are trying to move beyond that, and this is exactly the same playbook as what Lululemon did in the 90s. Lululemon took clothing from the yoga studio and they made it mainstream, and it got out of the workout space. And now if you look at Lululemon, it's a type of clothing that people wear outside of the gym. And I mean, the investment thesis for Figs is the same, is that you're making the bet that at some point people will be wearing scrubs outside of the environment where they were meant for, which was the hospitals, right? And to be even crazier, right? Jeans. If you look at the story of jeans used to be a working man's pants, and of course today most people who buy jeans, are not tradespeople. They don't work in construction or in trades or in gold mining, right? Jeans is a mainstream piece of clothing, but it didn't used to be. It used to be it used to be workwear. So are they trying to Lululemonize themselves? That's what I think they're trying to do. And this is from my early video covering Figs. And I had done a little bit of research, and this was their websites. Let me bring this to front. If you look at their website, I mean, the clothing is oddly similar. This is Figs right here. That's Figs, and that's Lululemon. And if you ask me, the clothing looks very much the same. They are trying to Lululemonize themselves. And why do I want to talk about Lululemon? Because the returns of Lululemon have been outstanding. The return of Lululemon have been great, and the stock is up quite a bit over the past 6 months. And this is a company that could take that same path. And lastly, Figs is backed by Ron Barron. Ron Barron owns 15% of Figs. This is a recent interview on CNBC from a few weeks ago where he explains that he thinks that by 2030, Figs is a 5x or a 6x. Imagine that. That'd be an outstanding return. We're almost in 2024. So he's extremely bullish on Figs. And of course, Ron Barron is known for his Tesla position, is known for being extremely bullish on Tesla. And so I find this very reassuring to have a mega investor, billionaire investor looking at Figs. But anyways, that's not enough for me to buy a stock, right? There's a lot of billionaires that buy the wrong stocks. No, the reason why I look at the stock is it's very cheap. It's dirt cheap. The price to sell is 1.77. P ratio is 70x, 78x. It's more important here to look at the P ratio to realize that, yeah, they actually have a P ratio, which means they're gap profitable, which means, hello, Wall Street should be happy, but Wall Street not happy. Enterprise value to free cash flow. So if you're a value investor, I think this is a more relevant metric. They're at a 12. So the future EBITDA, and EBITDA I use typically as a proxy for free cash flow. I find it much better than free cash flow. Enterprise value over EBITDA is a 12x. So that's an inexpensive stock in any world. The question, of course, if you were to buy a stock like HIMS is to ask yourself, how big could it get? How big could it get? Well, per that interview, this is data, fresh data from that interview. So the CEO, she's right there. The CEO in that interview explains that 85% of healthcare workers need to buy their own scrubs. For the rest, it's the hospital or the health system that buys it for them, and then they have a sales team that's dedicated to selling to health system should they be inclined to buy Figs. But for most health workers, they have to buy their own. And she explains that in the healthcare clothing market, Figs has a 5% market share in the US, but only a 1% market share globally. So this is an international expansion story as well, because the scrubs are an international piece of clothing, right? They're not very culture specific. And, Figs is a lifestyle brand. It's all about more than just healthcare. The anchor mentions that he sees some people, in the street wearing Figs. I know Figs is worn sometimes for gardening, believe it or not, and spending time outside. The CEO herself makes a comment here about people wanting pockets, and that this is a clothing that shines because it's got pockets, which is obviously extremely relevant for women's clothing, because if you know anything about women's clothing, it doesn't tend to have a lot of pockets. Well, there you go. Could Figs be a maker of women's clothing that has a bunch of pockets, just like a lot of men's clothing? Maybe. I don't know. I think it's a promising company, and the stock is dirt cheap, and I will be getting back into that company. A stock that I'm interested into, but I'm out of the stock for now. But I'm interested in this company as well, and that one is a pure valuation play for me. I mean, this is just a tad more expensive than StoneCo. Let me go as far as calling it as cheap as StoneCo and as cheap as HIMS. But of course, that's with a revenue growth of 15%. It would not take much for this company's revenue growth to double. And if it were to double, then this stock would be cheaper than HIMS, right? If it were to triple, it'd be the cheapest stock I've ever seen in my investing career. This is a stock, Lovesac, that I think has a price to sales ratio that I would call in the joke category. If I were to, and I just created that category for Lovesac. It's a joke category, 0.73x times sales, entirely ridiculous. This is a company growing at 15%, used to be growing at 30%. Gross margin is excellent at 56%. For the furniture space, think about that. For hardware, like this is a brick and mortar business. This is atoms, right? We're trading atoms. We're not trading bits. And they have a 56% margin. I can think of tons of businesses that only trade bits that don't have 56% margin. So this is insane margins. GAAP profitable, the P is 18x, 15x if you look at non-GAAP profitability, which is what I prefer. Adjusted EV over forward EBITDA, I like that much better than earnings, by the way, is a 9x. Of course, the most important for me is my metric, EV over gross profit or revenue growth at a 0.088, so very cheap. And the predicted growth rate, 15%. Like I said, what if it doubles? What if it doubles? Well, that stock would be the cheapest thing ever. The stock, in my view, would have to re-rate higher. The question is, how big can this company get? And furniture is a very competitive space. But let's be honest, in my view, they have carved themselves a niche in the marketplace. They're targeting more design-minded, affluent young buyers, right? They've carved themselves a niche, and they will have their customers and their niche, and within their niche, their customers will buy furniture. Is the way I view it. They have a defendable product. It's unique enough. I'm not saying that I would buy this product, but it's a unique enough product for me to compel an investment given these valuations. No investment advice, of course. And of course, the reason why this stock is cheap, and all furniture stocks, by the way, are dirt cheap right now, all of them, is because real estate is dead, is what the market would have you believe. But no, real estate is not dead. Really briefly about the product. What is the product of Lovesac? What do they do? They do about 20 to 30% of their business is these bean bags. And so bean bags are competing about Lazy Boy. I'll get to that in a second. The rest of the business is these reconfigurable to infinity couch. They call it the Lovesac system or ecosystem. And so if you buy, say, a few dozen elements, you can have tens of thousands of possible combinations because it grows really, really quick. And you can do things like, ridiculous couches like this. I don't even know. It's, what is it? It's like it's a 6-person bed or something. I don't know what that is, but you can do this. If you can think it, you can make a piece of furniture out of it. You can do a bed, you can do a swing bed, whatever. They have a unique niche in their marketplace, and they show you all of the possible configuration here if you can see. And of course, this company got started with bin bags, and I think they have disruption in them. I think they have that disruption DNA because if you really think about it, Okay, there you go. If you really think about it, what is the bin bag competing against? It's competing the recliner. So if you're not in the US, maybe you're not familiar with this brand, but if you're in the US, you know that Lazy Boy recliners are all the rage. At least when I first came in, they were all the rage. And I looked at the revenue growth of Lazy Boy. It's minus 3% in this environment, right? Minus 3% for Lazy Boy, plus 15% for Lovesac, and they both make similar products in my view, which is couches and sectionals. And so the question is the bin bag replacing the couch? Will people prefer buying these bags than these couches? And the reason for that, of course, is the advent of social media, right? If the main entertainment moves away from watching linear television and moves into scrolling on TikTok or scrolling on Instagram, then the bin bag is probably a better option for scrolling, right? But even then, if you look at Netflix, it's just not a stock I follow, but if you look at a company like Netflix, for example, one of the things that is a growth area for them is people viewing television or viewing shows on mobile. So what's going to be the share of mobile? Are people going to watch their shows on mobile, right? I see it in the YouTube stats. Most of you watch YouTube on mobile. Anyways, is it a better suited? Is it a disruptor? Well, I think it is somewhat of a disruptor, right? Not a tech disruptor, but a disruptor in the lifestyle type of space. And the last thing that I want to say, which to compare to Lazy Boy, but I use Lazy Boy kind of as a scapegoat here for other furniture brands, not just Lazy Boy. If you look at the productivity of a company like Lovesac, it's a newer company, right? Not founded that long ago. About 20 years ago, it was founded. The productivity is almost 500,000 per employee. Lazy Boy, the productivity is a little bit shy of 200,000 per employee. Modern day businesses have much greater productivity. The productivity of Lazy Boy, I don't know what's going on, but that productivity leads to go up. And sure enough, when you look at the margins for a product like Figs are much higher. Lovesac are much higher, about 10% higher gross margin than the margins for a product like Lazy Boy. Lazy Boy has much lower margins. The last thing I'll say is about the philosophy of how we still sell stuff today. And I'm a growth investor. I invest for where the puck is going to be. I invest for the future. The way a company like Lovesac sells products is they have showrooms. And really, they just pay people there to show you the product and demonstrate the product. But they're low-pressure environments where you just go in there and you just try the product and you have a showroom and maybe you buy it from home on your phone. It's the omni-channel way of doing commerce. Of course, when you look at a company like Lazy Boy, it's all about a very big store. And as soon as you walk in, you have a salesperson that catches you in the store, and you are their client, and they follow you through the store. And so Lazy Boy has fully commissioned sales staff, which is not something that you see for a company like Lovesac. And of course, if you look at the world of business today, where we are headed, we're headed towards a commissions-free sales. A lot of the modern consumer doesn't like to be pressured into buying anything. That's one of the secret sauce, by the way, of the turnaround of Best Buy. If you follow Best Buy and study Best Buy, and Best Buy was able to survive selling electronics in a world where everybody buys online, a lot of it has to do with them moving away from commissioned sales staff. So I think, and the footprint, the store footprint is not even comparable. One of them is just a tiny store in a strip mall next to a grocery store, very low rent. Another one is a big standalone store in the middle of a parking lot, in the middle of a shopping center near a highway. Not the same cost structure whatsoever. So that's why I'm fairly confident with Lovesac. The market, in my view, for Lovesac is making a mistake, and the market is also making a mistake, in my view, for Figs. So these are the Neobrands. These are the lifestyle stocks. Not for everyone, but the idea of a diversified portfolio. I don't want to diversify away from, say, high growth. I still want very high growth stocks. But you can have a high growth stock in energy, right? Energy revolution, electricity revolution, and sure enough, my portfolio is way too heavy. You can have disruptive assets like Bitcoin. You can have high growth stocks in fields like platforms, like Airbnb, right? That's a platform. Xometry, that's a platform. You can have high growth stocks in SaaS, in AI, in semiconductors. What's another bucket of high growth stocks is these Neobrands, these lifestyle brands, these new brands that are coming onto a marketplace that are able to disrupt. This is a corner of the marketplace that has the ability to grow quite a bit. And in my view, if you spread your bets across multiple growth potential companies that do not diversify, right? You don't want to diversify, but if you don't diversify, then I think it could be a compelling play. Anyway, I find these two companies compelling. This was not investment advice. This is just entertainment, no investment advice. Please like, please subscribe. Thank you for following the channel, and have a wonderful day.